I would like to thank the organizers of the Academy of Business and Retail Management regarding the invitation for the London conference, which is one of the very important academic events which take place. Thank you. I would like to present my paper on the topic of risk management and performance, which regards a case study of credit risk management in commercial banks. As we know, financial institutions, especially commercial banks, play a very important role in nation's economy. In a more concise form, Harvey in 2012 defined financial institutions as enterprise such as a bank which primary business and function is to collect money from the public and invest in financial assets such as stocks and bonds, loans and mortgages, leases and insurance policies. There are two important examples of depository and non-depository financial institutions. For the purpose of the present study, emphasis is laid on commercial banks as a key example of financial institutions worldwide. In any economy, commercial banks are main financial intermediaries, so they consider as the main supplier of credit to corporate sectors and the household. They accept deposits and provide financial security to their customers. This is because keeping physical cash at home or in a wallet could lead to loss due to theft or accidents, not to mention the loss of possible income from interest. The policy of commercial banks to make money results in the elastic credit system that is necessary for economic progress at relatively steady rate of growth. With increased pressure on banks to improve shareholders' return, banks have had to assume higher risk and at the same time manage these risks to avoid losses. According to Perez in 2014, commercial banks face 8 types of risks, which are market risks, operation risk, liquidity risk, credit risk, business risk, reputational risk, systemic risk, and moral hazard. Out of these 8 risks, credit risk is one of the 3 major risks, while the other 2 are market risks and operational risk. The risk management has the purpose and the scope of ensuring that the risk part of an investment implemented in a controlled and understandable manner. It's understandable manner for all those who are involved. So this is important to be considered. Basel Committee on Banking Supervision encouraged the use of know-how customer principle as a strategy to minimizing credit risk. Non-objective decisions made by banks executives may result to insider leading or lending to personal friends, persons without superior financial knowledge, or to meet personal agenda. As an answer to the problem would be the usage of very fine loaning systems and chiefly the measurable ones which are more objective. Changes in credit risk may reflect changes in validity of the portfolio bank's loan that may also impact the performance of the bank. In addition, research has shown that um, there is the view that varying profitability levels could be traced back to difference in credit risk as raised exposure to the risk is associated with a drop profitability of the institutions. According to Karugu and Nondi, empirical evidence supported the view of the presence of an inverse connection existing between credit risk and performance of financial institutions, suggesting these institutions are performing high poorly when their loans are exposed to high risk. Analyzing the financial performance of banks, which has been of large importance for academic research for decades. On Gore in 2011 submitted that performance of firms can be influenced by ownership identity. This could also be true of commercial banks. In Kenya, for example, any failure in the financial sector of any country has enormous implications for economic growth. This is because commercial banks dominate the financial sector in any country. According to Olo in 2011, the bank rewards shareholders with an adequate return on their investments due to excellent bank performance. However, the poor performance can lead to failures and increase in crisis. According to Attengen and others, in 2011 research, a balanced portfolio theory is also an important addition to the importance of banking performance. It states that management overall policy decisions affect the portfolio structure of the bank profits and the shareholders' return profits. The theories above show that bank performance is affected whether external or internal factors such as inside the bank of the size of the bank or the risk management capacity and management efficiency are important factors. It is fact that the Saudi economy is strongly connected to international economy. Hence, it is natural that the Saudi economy was affected by the financial crisis. The reverse impact of the global financial crisis on the Saudi economy was in the financial market, which has declined in past few years. The global financial crisis revealed the importance of banks' credit risk management in mitigating credit default risk, as most banking problems have been caused by weaknesses in credit risk management that include high credit concentration, inadequate credit risk monitoring, ineffective credit risk measuring, poor credit risk rating, insufficient lending procedures, vulnerability to liquidity stresses, and sensitivity to market fluctuations. Regarding the research questions and objectives the present study addresses is that in this period of global financial crisis, Saudi banks suffer from a high rate of default with adverse effects on banks' performance, which require investigating for a proper review of the policies of credit risk management. So, analyzing the effect of credit risk management on loan performance of Saudi commercial banks become essential for identifying the determinants of Saudi credit risk policies, core mechanisms through which Saudi Arabian banks minimize loan default and the impact of loan performance on the bank. So, which are the research questions which are expressed through this study? Is first, which are the determinants of credit risk policies of Saudi commercial banks? What are the core mechanisms through which Saudi Arabian banks minimize loan default? What is the impact of credit risk management practices on loan performance of Saudi commercial banks? Based on research questions, the following research hypothesis can derive. The first hypothesis is there is no significant relationship between credit risk policies and loan performance of Saudi Arabian commercial banks. The second hypothesis is there is no significant relationship between mechanisms to minimize loan default and loan performance of Saudi Arabian commercial banks. And the third one is there is no statistically significant effect of credit risk management policies on loan performance of Saudi commercial banks. In terms of the literature review, we have to mention issues about the commercial loan theory. This study adopts the commercial loan theory as used by Daivoud and others in 2017, where commercial loan theory is the oldest banking theory, also called the real bills doctrine. It is stated that banks should only lend on short-term commercial paper and self-liquidation. According to Honsna and others in 2009, the commercial loan theory is geared to influence persuasively both the bank lending and the general economic activities. Strict adoption of this theory will reveal that it is expected to serve as a monetary supply to changes to aggregate economic activity. Cargi in 2011 stated that the strong tie to this conception is rather orthodox if consideration is given to the fact that at the time of the supremacy of the theory there were little or no secondary reverse assets which could have served as a liquidity buffet for the bank. This study adapts the credit risk management framework by Wichira in 2017. According to Wichira in 2017, there are four independent variables that constitute credit risk management practices. The dependent variable is bank's performance as measured by ratio of non-performing loans to overall loans. The four independent variables directly affect the performance of the banks. However, for the purpose of this study, emphasis is placed on impact of credit risk management practices in terms of credit risk management strategies and credit risk policies as independent variables. Regarding the methodological approach and data collection for this study is that an empirical study through the distribution of a questionnaire took place according to Bryman and Bell in 2007. Quantitative research emphasizes quantification of the data collection and analysis. Usually quantitative research conducts a deductive approach to the relationship between theory and research, which focuses on testing of theory. In order to test the hypothesis, data were collected for four indicators which were described in a numerical way. The data collection was done directly by the researcher through the administration of structured questionnaires developed by the researcher through a pilot study which involved taking some questionnaires to some banks, credit managers in Saudi Arabian commercial banks. The population of the study consists of four commercial banks in Saudi Arabia, which were selecting using the random sampling method, and the target population of the study included bank employees, assistant managers, and key managers. And regarding the data analysis approach for the collected data to be easily understood by the common researcher, it needs to be analyzed. So quantitative techniques were used to analyze the data after receiving the questionnaires from the respondents. The responses were edited, classified, coded, and tabulated to analyze quantitatively data using statistical package for social sciences. The inferential statistics was applied to establish a causal effect relating independent variables to the dependent variables. A linear regression of financial performance versus credit risk management was applied to establish the effect between variables. The model treats financial performance of commercial banks as a dependent variable, while the independent variable is credit risk management. The main aim of the study was to establish the effect of credit risk management on the financial performance of Saudi commercial banks. Thus, the study had specific objectives, which include identifying the kind of policies often adopted for loan recovery purposes in Saudi Arabia, core mechanisms through which Saudi Arabian banks minimize loan default, and determining the effective credit to facilitate loan performance in Saudi commercial banks. And the study findings established that most of the commercial banks in Saudi Arabia had a formal written credit policy manual, and that they were reviewed on various times as the need arises. The analysis of variance revealed that there is a very high effect of credit risk management and financial performance of commercial banks. In Saudi Arabia, regression results have shown that credit risk analysis and assessment, credit risk identification, credit scoring mechanism are positively and very significantly related to the financial performance of commercial banks in Saudi Arabia. The findings of this research are in support of those by Afhir and Akote in 2011, who sought to find out the impact of credit risk management on the profitability of rural and community banks in the Bronx region of Ghana. Their study found a positive relationship between credit risk and profitability of the community banks, just like the findings of the study found that the banks benefited from the high credit risk. These research findings are contrary to those of Pudel in Nepal. The study by Pudel in 2012 was done to determine how credit risk indicators like default rate are pertinent to credit risk management in affecting banks' financial performance in Nepal. in agreement with the conventional views, the study found a negative relationship between credit risk and financial performance of banks in Nepal. The findings of this research, though, are also contrary to those of Ogbowi in 2013 in Nigeria, where this research carried a study to find out the effect of credit management on financial performance of banks in Nigeria, and there was found a negative relationship between ROA and credit risk indicators like loss provisions, loans and advances, and loan performing non-performing loans. The inconsistencies of the results in these different countries could be explained by the differences in banking regulations between the different countries and the number of commercial banks in the different countries. The present study concluded that the credit risk assessment, credit risk mechanism, and credit analysis and evaluation are good indicators of the model, and therefore the three indicators used in credit risk management have shown a positive relationship with the financial performance of commercial banks in Saudi Arabia. The study also concluded that the approaches used by banks in screening and risk analysis before granting credit to customers were very effective. The results of the study concluded that capacity, competition, and conditions and the approaches most often used in risk analysis are well performed. Finally, the study found positive effects of credit risk management of the performance of loans within Saudi Arabian banks. On the significance of this study, it will help the management of commercial banks in Saudi Arabia to gain insight on the relationship between credit risk management practices on the loan performance of commercial banks, and as a result adapt appropriate risk management practices in reducing the level of non-performing loans and enhance loan performance. And this study will also be useful to the government in policy making regarding the loan requirements and also for the supervision of commercial banks. The policymakers will obtain knowledge on the best mechanisms that should be adopted to curb the poor loan performance, and the responses that are appropriate should occur. And this study therefore acts as a guide in adopting effective risk management practices by commercial banks, and contributes to literature theory by showing that how credit risk management practices can affect the performance of loans in commercial banks, which adds on the body of literature on the effects specifically of credit risk management practices and on the management of lending portfolio of commercial banks. This is the very brief description of the present research, and I would like to thank you again for this kind invitation in this conference. Good luck with the rest of part of the conference. Thank you.